Good morning, everyone. I want to thank you for joining us today for our webinar, Post-Crisis Reserve Funds and Cash Management. My name is Justin, and I'm the Regional Controller at First Service Residential. I'm joined today by Robert Nordland, Founder and CEO of Association Reserves, and Drew Schlegel, Executive Vice President of High Rise and Mixed Use at First Service Residential. Before we get started, I'd like to go over a few housekeeping items. First, as with any technology platform and webinar, there is potential for technical difficulties. While we don't anticipate any at this time, we appreciate your patience if they arise. Also, feel free to take notes, but the webinar is being recorded, so we'll be sending you the full webinar. Lastly, please keep your phones or microphones muted during this webinar. You'll have the opportunity to submit questions at the end of the presentation via the chat box on the right side of your screen. As mentioned, I'll be your moderator today, and Robert Nordland and Drew Schlegel will be sharing some great best practices on reserve funds and cash management. I wanted to take this time to have each of them share a bit of who they are and what they do. Robert, could you take a quick second to introduce yourself?
Sure, thanks, Justin. As everyone can see on screen, I'm the founder and CEO of Association Reserves. We founded the company back in 1986 to guide associations, now thousands of them all across the country, towards a responsible and improved future. A hallmark of our work is easy to read reserve studies, with everything based on the solid and reliable principles of National Reserve Study standards.
Thanks, Robert. Drew, you want to take a moment to tell us about yourself?
Yes, thanks, Justin. Yes, my name is Andrew Schlegel. I go by Drew. I've been with First Service Residential for approximately 15 years. I am in charge of our high-rise and mixed-use projects throughout California. My background is originally in public accounting and banking, and I have a keen interest in all things financial, including reserves, and also help many HOAs get through the mortgage meltdown crisis we had in 2008, 2009. I'm always looking out for best ways to monitor cash and make sure our clients are stable financially.
Thanks, Drew and Robert. Before we jump into the meat of our presentation, I wanted to share a little bit about what we do at First Service Residential. As the leading residential property management company in North America, our business is building and managing happy, healthy, expertly run communities. In the wake of COVID-19, our core values inform the decisions we make, and our unwavering commitment to our associates, clients, communities, and partners remains true. As we adapt to the current challenges, our goal is to share best practices that keep your community's best interests in mind. I also wanted to take this time to share a quick legal disclaimer. The webinar is provided for information purposes only and does not constitute legal advice. During our presentation today, Robert will be sharing his expertise on how to manage reserves in a time of financial shortfall, including ways to conserve cash, prioritize reserve expenses, safely reallocate funds, and save money in a financial downturn. Then Drew will be speaking on some cash management and collection best practices. Last, we'll have a Q&A where you'll get a chance to submit your own questions. Now I want to hand it over to Robert to share some best practices on how to look at our reserves during a time of potential financial shortfalls. First of all, Robert, whether our associations are doing okay financially or beginning to see a struggle, we know that preparing for the future is key. What are some practical ways we can prepare our budgets for the future?
Well, thank you again, Justin. Many boards now are asking what they should do in the midst of this financial downturn. And my answers are in line with the best practices everyone already knows. For instance, it all starts with the basics: assembling your information, which is your most recent financials, reviewing and adjusting the budget, tightening your belt, maximizing your collections and messaging to the owners, working with your legal counsel to see what options or restrictions you have based on your governing documents or state law, and then only after you've done those do you look to reserves as a cash flow option. It's not one of your first steps. The bottom line is either your association is in a financial jam, or based on the unemployment figures we see, it soon will be in a jam. The bills keep coming, and that voice in your head says, don't raid the reserve fund. So you're stuck between two bad choices. And because many have described this as an unprecedented situation, you don't have a roadmap to guide your choices. But I want to give you hope. Even though you need to act as a board member and you may not be sure of the right thing to do, you can safely move forward. The key is applying the principles that come from the business judgment rule. If your decisions are ever challenged, the business judgment rule provides you a defense, but it requires you to follow a three-step process. You have to show that you are acting in good faith, in the best interest of the association, and with due diligence, and that means asking questions, not just winging it on your own.
Robert, a lot of associations aren't sure where to start when it comes to prioritizing reserve expenses. If there's one piece of advice you could give them to start with, what would that be?
Well, when it comes to prioritizing, the problem is that most boards think that all reserve projects are created equal. They see that long list and they think they're all the same. That's a mistake. Different types of reserve projects differ in importance to the association. When cash is tight, your first step is to spend less money. So let's focus on that first. Thinking of the Hippocratic Oath, don't take any action that would cause additional harm. And the key is knowing which projects are better to defer than others because they are different. In general, there's 5 different types of reserve expenses. Those that are inconsequential, the ones described as reevaluate, those that are based on physical or aesthetic or technological obsolescence, those that are done to protect the assets of the association, and those that have catastrophic consequences. Let me start with a couple examples of inconsequential components. These are projects that meet the National Reserve Study Standards definition of a reserve project, but they're projects like replacing the little used hot water heater in the pool bathroom, or replacing the carpet or repainting the walls of the back stairwell that actually most people don't even use because they ride the elevator. And reevaluate projects are like a wood fence that you can look at or shake to see if it's still doing its job, or maybe it just needs a minor repair. Or perhaps it's like the flooring for the security office. It's worn and needs to be replaced, but it's really not a problem to push it out yet another year. And here's a couple examples of obsolescence. One is an old and worn entry sign that's pretty much ignored by all the residents. They just drive right past it. Obviously, actually, if the picture was even bigger, you could see it's way past its prime. But another is a main entry lobby, and that's a critical first impression feature for this high-rise. And you'd be sure that you'd hear about it if there was even a minor stain on one of those pieces or on that carpet. Now, the protection category has to do with projects necessary to protect or preserve a major asset, like the siding painting shown here on the left, or perhaps sealing balcony decks. On the right is what it looks like when you don't do a protection project, like sealing the asphalt. In that case, what you see is you end up having to entirely replace the asphalt because it has failed. And that's expensive compared to a very inexpensive seal coat project. And finally, we get to the catastrophic category. These are the projects that you do on time or perhaps slightly early because the consequences of failure are so undesirable. It could be scheduling the replacement of the old water heater at a nice time in the middle of a day because you don't want it to fail on a holiday weekend and leave everyone without hot water for days. Or it could be the simple little gate opener motor, not the kind of thing you want to break and leave your association open for days while a new part is ordered and installed. So I summarized these 5 types in this chart. It's kind of like a traffic light. When cash is tight, red means stop. So stop doing any inconsequential projects. For reevaluate and obsolescence, exercise caution and defer the ones you can. Moving forward, making sure you're only doing the projects that have merit. And green means go. Do your protection or catastrophic projects on schedule. Don't defer those projects. And here's what it looks like for a client that contacted our company asking for some help. They had some significant expenses, as you can see, in the first 2 years, and no reserve expenses in the 3rd year. So after looking at their component list, we found there were a number of projects that we could slide into that 3rd year. And so this is what it looks like. Now look at how those first 2 years have relatively low expenses, with that 3rd year being the expensive year. And what it means is we're able to defer about $235,000 worth of projects, and that's the key word, the word defer. So in conserving cash, the idea is there is no savings. And let me say that again, no money saved. It's just the same projects now being done later than originally planned to help the association with a cash flow problem. It's just deferring projects.
Robert, since we're talking about reallocating cash from reserve to operating funds, those funds will obviously need to be paid back. What kind of time period is appropriate for that payback?
Okay, well, we're shifting gears here from conserving cash to reallocating cash, and that question is a great start to this new subject. When the funds are repaid depends both on the timing of the association's upcoming reserve projects, meaning when that cash will be needed, and the association's governing documents and state law. So it's not a one-size-fits-all answer. It could be a 1-year payback, it could be a 2-year payback, or a payback spread over many years. It's just plain, unfortunately, not a simple answer. When it comes to reallocating or redirecting cash, there's 3 ways it can be done. You can reduce your reserve contributions, temporarily stop or suspend your reserve contributions, or directly borrow from the reserve funds. Now, for the purposes of this webinar, I'm going to consider them all borrowing because for practical purposes, you're depriving the reserve fund of the cash it was counting on. And that cash fundamentally needs to be restored. Now, here's a chart that shows what we found is the amount of total budget that needs to go towards reserves to offset ongoing deterioration at our client associations. At the bottom of the chart, you can see our most common recommendation is reserve contributions in the range of 25% of total budget. Some associations are more on the right and some are less on the left, but 25% is a pretty common recommendation. So I'll start with that assumption for the next few slides. And here in a pie chart, you see an association's budget where 25% is going towards reserves, leaving 75% for the operating budget. And now notice what happens if you reduce your reserve contributions to just 20% of total budget. This opens up a new 5% that can now stay in the operating budget, offsetting a 5% increase in delinquencies. That's a pretty nice start. And then on this slide, I show what it looks like if you reduce your reserve contributions down to 15% of total budget. And that means you've opened up 10% more cash to stay in the operating fund. This is starting to look like a great opportunity for an association with a cash-starved operating budget because of rising delinquencies. But I want to caution you, whatever your starting point, don't go down too far. Don't reduce your reserve contributions below 10% of total budget because that causes its own set of problems. It puts the association's FHA approval at risk. Now, 10% of total budget is a standard many mortgage lenders want to see, so it's not smart to go below 10% of total budget in your ongoing reserve contributions. Here's what a standard multi-year reserve funding plan looks like. It's smooth over the years, gradually floating upward with inflation. And for this association, as I look on screen, it looks like it starts at about $70,000 a year. And let's presume this was the association's original plan at the start of the year. And then due to cash flow problems here in 2020, they either reduced their reserve contributions or suspended them for a few months, resulting in significantly less reserve contributions than planned. For this association, looks like it frees up about about $20,000 of cash to prop up the operating budget. And these are funds that will need to be repaid, but I'll get to that in a few minutes. Now, borrowing from reserves goes against conventional wisdom, but I want to assure you that this can be done if done carefully, and it's even supported by National Reserve Study standards. Now, presuming your adjusted plan provides sufficient cash for the upcoming reserve projects, the bottom line is that whatever funding plan you create needs to be fiscally responsible. Stability and even distribution through the years is nice, but sustainability of the association is paramount. It's not fiscally responsible to protect reserve funds when they are desperately needed to rescue the association. And then from my background, it's times like this when I think back on what Gene Kranz said when he was flight director for the Apollo 13 mission. And if you remember, that's back when the astronauts had that problem with their spacecraft. He said, let's work the problem. Let's not make things worse by guessing. So let's not guess. Let's look at the numbers again and make informed decisions, like the due diligence when asking questions that you need to ask to find out what you need to know. And that's part of the 3 steps of following the business judgment rule. Now here's a chart of the reserve balance at an association that's fully funding their reserves. The blue bars are the target fully funded balance through the years, and the orange line is their actual reserve cash balance. And you can see it approaching the fully funded level over the years. Now, even in the big expense years, the orange line never really drops very low. They have margin. Now, this is the margin that's available to be tapped, or you could say borrowed, as a cash infusion to the operating budget. And here's the same association, presuming they're baseline funding their reserves. And baseline funding means their plan is to just barely keep the reserve fund cash positive. The point is that for baseline funded associations, the cupboard is already pretty bare. That orange line is pretty close down to the 0 point. There's not much cash to borrow. So borrowing from the reserve fund for baseline funded associations is not really an option, okay? Now, when the reserves are borrowed, they need to be paid back. Look at this chart showing a funding plan, in this case, starting at about $200,000 in the first year. Now, let's suppose this association digs into the reserve fund and pulls out $100,000. The question is how to restore those funds. Now, it can be pretty simple. A $100,000 special assessment the next year, or 2 $50,000 special assessments over the next 2 years. You get my point. But I want to show you something interesting in the next slide. Now, this is what payback looks like if the association restores that $100,000 over many years. If I could get you to flip back and forth from the last slide to this one a few times, you can see that the difference from the original plan is that when you borrow, you drop in the first year, but in the subsequent years, it's a little bit higher for 29 more years. Now, if your association has time to rebuild the reserve fund, spreading out the payback over a number of years, it's really not very painful. So the issue with reallocating reserves to operating is managing the borrowing process and restoring the funds, making informed decisions in the best interests of the association.
So Robert, I'd love to jump into some practical tips on how to save money in a financial downturn. And I want to ask, are there any gotchas associations should be looking to avoid?
Good question. Well, we finished the difficult reallocating subject, borrowing and paying back, and we'll shift to that easier topic of literally saving money. But there is a gotcha, and that gotcha to avoid is updating your reserve study, presuming that you're going to have that COVID-19 discounted price in the future. Now, discounts that are available right now are only temporary. You shouldn't build your multi-year reserve plan expecting similar discounts 5 or 10 years into the future. Now, I want to show you some neat pictures here. This is illustrating some ways to save money during this time. On screen, you see some photos I took in the last few weeks when I'm out on walks in my neighborhood. On the left, you see a condo association next door, and I was actually surprised early on in this lockdown to see them painting. So me being me, I called the manager and found out they were offered a 10% discount if they went right ahead on the project right now. Now, it meant taking 3 to 4 weeks to get painted because they'd be working with a smaller crew, but saving 10% on building painting was a nice incentive to move forward. And in the center, you can see some painters working outside, nicely physically distanced. And on the right, you see a photo of a local commercial facility that was resurfacing their parking lot. And that was a nice project to do when there were no employees at the building and no cars to work around. The point is, look at your reserve study and contact the service providers that you're anticipating for 2020 projects and see which ones might tempt you to do the project right now instead of later this year. I'm going to go back to numbers again. Here's the projected annual reserve expenses for yet another client that reached out for some help. We looked at their 2020 reserve projects and saw one that involved a lot of labor. It was replacing their windows. So we encourage them to reach out and check with the installer. Well, you can see that the expenses are in the $200,000 range. And after checking with the installer, they were told they could get a 5% discount if they launched the project right now. So they went ahead and did it and saved 5% on a big project. So that's a nice sweetener, getting a discount. Now I want to take a moment, and I've talked about looking at the numbers, knowing what you're doing, no guessing. I want to show you the tool I use for the charts and the analysis I did in preparation for this webinar. On the topic of reserves, that means reviewing your reserve study, and hopefully you have one for the current year. Well, if you have it, then maybe that means checking in with your reserve study provider and have them run some numbers. Or, and what I want to introduce is doing some what if testing yourself. And for this presentation, I used our online calculator that we call uPlanet. Access to uPlanet is free with all our professional reserve studies. And beginning in 2020, June actually, next month, we're making it available to all associations on a subscription basis for just $149 a year. It's a great little tool. It's a great way to take ownership of your reserve planning process, allowing you to find out what happens when you adjust some of the numbers. So what am I recommending? And just actually what I started with. Identify your predicament, do the first things first, gather your numbers, tighten your operating budget, make sure you're on top of your collections, and reach out to your advisors, your manager, your attorney, and your reserve study provider as appropriate. Then if you're still trying to bridge a financial gap, use reserves to help rescue your situation by either conserving cash by deferring projects, reallocating cash from reserves to operating, meaning borrowing and repaying, and finally, saving cash by enjoying some bargains. And of course, document your process, showing that you are working in good faith, in the best interest of the association, and after exercising due diligence.
Thank you so much for that, Robert. Now I want to turn it over to Drew. He has some fantastic advice to share regarding post-crisis cash management. Drew, can you kick us off here?
Sure. And thank you, Robert, for that education on reserves. And by the way, that's one of the key fiduciary duties of any board, is to make sure you have adequate reserves. It does have an impact on property values. I've found when communities are under reserved, it can actually steer people away from buying there. So it is an important aspect of everyone's financial management. And speaking of that, let's dive right in here to cash management during a tough time. It's probably one of the most important things a board does, and you should always be looking at your cash metrics. The goal is to use every dollar wisely and maximize the value of each dollar. When we're getting tighter on the money coming in, then we even need to be more careful about it. So it's very important to look at where your revenue sources are coming from and the velocity of them. You need, at this point in time, to do some more real-time monitoring. If your financials are coming a month late from your management company, it's a little late to know how you did on collections. So I'll show you in the next slide what we're doing as a company to have more real-time monitoring of your cash collection trends. I had many board members ask me right off the bat, are we gonna have a lot of trouble with collections here? And I had to remind them that all the payroll protection efforts and enhanced unemployment benefits and the stimulus check, a lot of that is designed to help people pay housing expenses. So hopefully a lot of people are paying their dues. And we've noticed that there hasn't been a huge reduction, but we're not through this yet. And those stimulus efforts from the government will end. So we still need to be careful, at least for the next few months. And another thing you need to be aware of is that ancillary revenue will likely drop. Your move-in, move-out revenues, your facility rental revenues, those revenues are going to drop in addition to your assessment revenue. So we need to anticipate a shortfall in revenue. And finally, one other thing when it comes to collection trends, if you have apartments that are contributing into your HOA or commercial, we're seeing a little more trouble in those parts of the market where folks had to shut their business and they're having trouble paying their lease payment. We're seeing some people are not paying assessments or their cost sharing from commercial or apartments. So keep an eye on that too. So what you're seeing on your screen right now is what we're doing throughout our whole client base. We are analyzing their cash flow and collection 2 times a month, on the 15th and then on the 30th. The example here is on the 15th. We're looking at cash collections, say for the first 15 days in May versus the first 15 days in April versus the first 15 days in March. And we even went back earlier on some into February. And then we're trying to see, are we experiencing shortfalls, real-time shortfalls in cash collection? And if we are, we need to take action more quickly. You can see there, we color-coded them green, yellow, and red. The first one that's yellow, you can see 87.9% collected versus prior months. And that's a warning sign. That's a little bit of an indication we need to be looking more carefully. The one in red that's 21.2, the reason that's that way is they have quarterly assessments. So you need to take that into consideration too. If you have quarterly or annual assessments, obviously these metrics are going to be a little different. The other important metric is how many months of operating cash do you have on hand? That's in the far right column there. We advise our clients to have up to 1.5 months worth of operating cash at the end of each month. In other words, when you finish a month, you have a little bit extra going into the next month so that you don't have to fuss around with suspending reserve contributions or holding off on paying a vendor. You know, you're pretty good. And if you have a shortfall in some revenue or so bad collection month, you can still pay all your bills. The one that's you can see in the third row down that has only 1/10 of a month of cash, that's a little bit too tight, right? You have no margin for error there, and you're likely to have to suspend reserve contributions or perhaps even borrow, as Robert talked about. But we're trying to not fuss around with that if possible. Further down, you see the first yellow one. It says they have 1.29 months worth of available cash on hand. Well, if you look at the budget, it's 1.8 million a month. And so the bigger your budget and the bigger amount of assessments you collect, the less important it is to have a whole month's worth of cash in there, because obviously there's cushion in there with that large of a budget. Having said that, you can see the one that was 21.2% of collections, and you note that they have over 2 months worth of cash on hand. So they're cool. They can weather a little bit of a downturn. But the key is to keep looking at this and do it more than once a month. In fact, do it as real time as possible. So partner with your management company to get that kind of information. So let's talk about how to manage cash if you are having a shortfall. Well, most of us have had to shut down our amenities, anything where there's gatherings of people, your fitness facilities, your gyms, your conference rooms, your clubhouses. So as we're losing the revenue associated with renting those things out and or just having to shut them down because of distancing, we should be also trying to save money by turning down lights, adjusting the heating and cooling, and perhaps even looking at staff. If there's staff associated with monitoring those amenities, well, it's time to have a little bit of a furlough. And perhaps those folks, I know we as a company have done it, and our associates that might have had to be furloughed are getting some unemployment to help make up the difference during this time. Meanwhile, that helps our clients save some money when they're not getting the normal revenue flows. But do keep in mind that even though they're closed, you still need to keep them clean. And as we roll forward and reopen, which is we're doing right now in a few different areas, but we're reopening with social distancing requirements and with capacity requirements. So that requires someone to monitor it. So we are going to need to have staff, even though the usage is going to be lower. Another area to look at is landscaping. So if you had some non-essential projects that you were doing, say tree trimming, you might want to postpone those. You could also potentially pull back on some of the routine schedules, because there's probably less wear and tear on, say, parks and sports fields as they've been closed. But don't, if you have a fire abatement issue like slopes or something like that around your community, you do not want to neglect to keep current on that, because all that does is create a bigger mess later as the weeds keep growing, and then you're into the fire season and you need to have a host of people there to get it cut down. So landscaping is one. Just look at it. Look at the scope of work and consider what's essential and what's not essential. Tree trimming, you could probably postpone a little bit. And this gets back to what Robert was talking about earlier with projects. Be strategic. And what we mean by that is if there's a time to hire a vendor at a good price, it is probably now in some respects. And so maybe you can get a good deal. And maybe it's the right time to do things because it's less inconvenience on the residents. For example, we have a community that has a large amenity area that has beautiful hardwood floors in it. Well, most of that area is all shut down. So this is a perfect time to go in there and refinish the floors. And by the time it reopens, they already look great. And so it was really good. We didn't have to inconvenience folks. We didn't have to stage the work. We could just get in there and get it done. The same could be said for like painting a fitness facility or renovating or maybe restaining some outside furniture, et cetera. So that's what we mean by being strategic. Think about the things that it's an optimal time now to get it done because of the fact that there's less usage. And then finally, just overall, be conservative with expenses. Most people, if they had large social events, those things are non-essential and you can't do them anyway because of the distancing requirements. But there are other things that might be nice to haves that you put in the budget because you were trying to add value to your community and you wanted to enhance the lifestyle there. But if it's not essential for health and safety reasons or aesthetic reasons, then maybe hold off on it a little bit just until we get through this tough time. So finally, what about collections? And if I heard this once, I heard it a dozen times, if not more, from board members. Should we suspend or reduce assessments? And even homeowners are questioning, why am I paying assessments when the amenities aren't open? And the answer to that is no, you should not suspend or reduce assessments. There are too many unknowns going on right now, and there's very likely to be a loss of revenue that has to be made up by having at least good collections. If we suspend or reduce assessments, hoping that we can reduce some cost in a certain area, and we don't get the revenue that we were expecting, then we're really in trouble. And do keep in mind that anytime we don't collect an assessment from one owner, that means the other owners are really picking it up. So, you know, I know we're really tempted to be compassionate with folks who are experiencing a hardship and during this time and, you know, want to give them some forbearance. And, you know, I see many boards doing that, at least slowing things down a bit. But our advice is to administer the delinquency policy just like you always have, because you don't want to come out with a blanket statement such as, oh, we're going to waive late fees. And then what happens is people are going to take advantage. I hate to say that, but it's human nature. They might just take advantage of it and say, well, I'm having some uncertainty. Maybe I'm just going to hold off and not pay my dues. We really don't want to get into that scenario. So we're advising everyone to keep going with administering the delinquency policy. And then if the board wants to show forbearance to a particular homeowner, they can exercise forgiveness on a case-by-case basis down the road. But we think that's the more appropriate way than to do some kind of blanket adjustments to the collection policy or to suspend or reduce assessments. So having said all this, hopefully we'll weather this. And if it turns out that we were able to cut costs and say we did suspend reserve contributions for a couple months, just to be careful about it. Well, by the end of the year, I'm almost certain, hopefully, knock on wood, that we'll be through this. And if it turns out there's a surplus, well, the board will have options. They could do a one-time reserve contribution to catch all up, back up, or add to it. Or they could do an assessment holiday, say in December, we're going to lower the assessment by half just for 1 month. Or they could just hold on to it and get their operating cash levels up and not have to do any increases next year. So again, this is all about cash management in a time of uncertainty, knowing your trends, knowing what's happening with your owner base, and some demographics are different than others. So I really urge you to partner with your management company to know what's going on with collections and make the necessary adjustments, and make sure you're not at a point where you're completely out of cash and you have utility bills to pay or insurance or something that is really vital and we don't have enough cash to do it. So that is my advice on cash management during this time. And I believe we're now in the mode to do some Q&A.
Thanks so much, Drew. Really appreciate that analysis. Now I'd like to take this time and open it up to your questions. Please submit your questions via the chat box on the right side of the screen, and we'll do our best to answer them. If we don't get to all of your questions today, please reach out after the webinar and we will try to answer them directly. All right, we have some questions coming in. First, I think, Robert, this would be for you. How much should be in the reserve fund relative to operating funds?
As far as cash balance, I think we heard Drew say that at the end of the month, you want to have at least a month's margin worth of operating cash. I've heard others say a month or two. So that as far as operating cash, that's how much to have in there. As far as how much you need in the reserve fund, that all depends on your upcoming projects, the timing of those projects, the magnitude of those projects. You find that in a reserve study. Now, the answer to the question, how much should you be contributing? That's a little easier answer. I showed that in the slide earlier. It's common for associations to need to set aside about 25% of their budget towards reserves just to offset the ongoing deterioration of their common areas, because deterioration is expensive. Common areas are expensive. We say 15 to 40% is a pretty typical range.
Thanks, Robert. What are the implications of an association that chooses to invest funds earmarked for reserve projects into revenue-generating investments in anticipation of project delays due to COVID-19 restrictions?
Yeah, that's a good question. Most HOAs have an investment policy, and there's usually three prongs to that. The first one is, first, don't lose any principal. The second, make sure it's liquid when you need it. In other words, make sure the maturities aren't further than when you need the money. And then third priority is to maximize yield. So yeah, we're all chasing yield. I know that even in our own personal lives, our retirement accounts or whatever, it's hard to find a good return. We're counseling most of our clients to just ladder their investments out to different maturities based upon when they will need the funds. And obviously, the longer you go further out in a CD, the more interest you can get. There are some other vehicles that are, not that risky, but I frankly, if I was on a board, I would not want to have any investment that could potentially result in a loss of principal. I don't want to be the one who was in charge when the stock market took a sudden downturn and our reserve funds went down by 15, 20%. And maybe some people say, hey, well, let's invest in bonds, municipal bonds or government grade bonds. That's less risky and you can get a little bit higher return, but you got to evaluate the delta between, or the beta, the risk between getting 2.5 on a government security versus 1.75 on a CD that's guaranteed by the FDIC. So that's the way I look at it. I believe this is one of the areas where we need to be very conservative.
Yeah, Drew, I concur. I continue to hear POP, protection of principal. And in this time when the board clearly has a lot of problems to work with, a lot of distractions, trying to squeeze a little bit more out of reserve funds may not be their primary responsibility. That may be a distraction at this time. If you could see me, I'm sitting here in my office with my arms crossed because there's nothing I like about that question.
Well, and a follow-up to that question, how should the HOA document this decision? Drew, I think I heard you say that is the decision. There should be some sort of investment policy on record, correct?
Yes, absolutely. You don't want to appear as though you're doing this in a reactionary way. It should be something that's well thought out, and you have a policy that guides the board, and that protects you from when there's changes in a board. Hopefully the next board will agree that this conservative policy is good. But having said that, boards can do what they want to do, and if they get a majority of the quorum to vote for a higher yielding investment, then that's their prerogative. But it needs to be well documented and even put in the minutes, I would say.
Thanks, guys. Robert, what would you recommend if we're in the middle of a multi-year special assessment?
That's a good question. Well, it depends on the reason for the special assessment. If the special assessment is to pay back a loan, then that obviously is a discussion you're going to need to have with your banker, the lender, to see if they can renegotiate terms. If it's to prepare for what we described earlier as a protection or a catastrophic project in 2 or 3 years, I would say try to press hard and try to collect those funds, because again, the consequences of not doing a protection or a catastrophic reserve component, those are things you don't want to face. So you might want to reach out to your reserve day provider and have a conversation with that. If it's just a matter of rebuilding the reserves, something that happened a few years ago, that's more likely that you can stretch that out. So it all depends on the situation, the reason for the borrowing, and the reason for the repaying.
Thanks, Robert. This next question, Drew, I think it points directly to your slides on the months of available cash. If months available cash is significantly below 1.5, how can the HOA remedy this? Is this something that can be included in the annual budget to make up in the following year?
Yes, obviously it's you don't need to panic, right? If you're below a month. The civil code in California basically says you should assess just enough to cover your operating expenses and reserve funds. We're not supposed to pile up a war chest of funds. However, it is better to have just a little bit of cushion, just like we do in our own personal lives. No one wants to live paycheck to paycheck, and HOA doesn't want to live month to month. So how do you build it up? It is best done when you're considering the budget. And I know we all like to have really tight budgets where we make it agree to our contracted services with the landscaper, or what we're looking at utility rates, or what our staffing costs actually are. No one likes to raise assessments. I get it. I totally get it. And I don't like to pay more assessments every year, but everything keeps going up in cost. The cost of labor, the cost of insurance, the cost of utilities. It seems like it's on a steady grind upward. So my advice is to always just if you just put a little bit of cushion in some lines, or if you'd like, you even can put in a contingency line. And that basically is not to be spent. And if you have, say, an extra couple grand in that budget line, then at the end of the year, that will help you pile up some operating cash if you haven't spent it. So there's no magic to this. It's simply watching the cash carefully and just being disciplined enough to hang on to a little bit more at the end of each month.
Thanks, Drew. Robert, this one's for you. Can you say again what the issues are with regard to how fast you need to reimburse reserves for any funds borrowed?
Sure. My understanding is that this webinar is going out to California, Nevada, and Arizona. There's no state laws, to my knowledge, on reimbursing reserves for borrowed funds in Nevada or Arizona. In California, there's a 12-month requirement that the borrowed reserves be restored with an asterisk. And the asterisk is if the association can demonstrate that it's in the best interest of the association to have an extended payback. So in California, the state law says 12 months unless it's in the best interest of the association to extend. So that's why I threw in that slide there showing how it's a nice way to pay back, I think it was what, $100,000 if you can spread it out over a number of years. So it also depends on the needs. Again, if I showed that slide about a baseline funded association where the reserve cash balance was really pretty low. And so if that's kind of association that is tapping into their reserves, you've got to reimburse that pretty soon, just in order to be able to have enough cash to be able to perform your necessary projects. So it depends on a number of factors, but be prudent, document it. You're going to hear that all the time. You heard it in our presentations. You're going to hear it in our Q&A. Document your decision making, ask questions. Can we afford it? What's it look like if? And that may mean reaching out to your manager, your reserve study provider, and just making sure that you're clear on what the needs are and what an effective solution is.
Yeah, I'd like to build on that just for a second. Say, for example, you have some issues with cash flow. You have unexpected expenses or whatever, and you can't fund reserves for a couple months. Well, you do want to record that on your balance sheet as unfunded reserve or a due to reserves, because you pledged to the membership that we're assessing this amount to everybody, and part of that is going to be paid to reserves. And if you can't do that, you need to at least carry it on the financials during that year. But then the key thing is, when you do next year's reserve study and next year's budget, make sure the analyst knows that we did not fund to schedule and that our beginning cash balance in reserves is lower. And therefore, when he or she does the study, they will recognize that there's a catch-up provision in there. And we're either going to catch up sooner or spread it out over years. But again, this is about disclosure to the resident, to the owners. We pledged that we were going to collect assessments and fund reserves to this level. And if we couldn't for some reason, then we need to restate our reserve funding levels in the next budget. And that reserve study, in essence, provides the roadmap or the plan for repayment of those funds that were not contributed in the prior year. The reason I bring that up is I see some people keeping unfunded reserves on their balance sheet for many years, for where it straddles over a year. I don't think that's necessary, as long as your reserve study is accurate and reflects the actual cash on hand.
Drew, I think you emphasized not vacationing assessments at this time, but interesting question here. What are your thoughts on increasing dues at this time?
Sometimes you have to. There's emergency special assessments all the time. Say that there's, some balconies are failing, or there's an unexpected equipment failure or plumbing leak. So sometimes you do have to increase assessments, and the board does have the power to do that. Up to in mid-year, you can increase it. You can't go, an increase can't be more than 20% in California. But you can do a mid-year assessment increase. You just need to notice the membership. And obviously, if you're noticing the membership, you do want to give them some reasons why. So in this current time frame, it might be that we're having collection difficulties and we didn't budget for that much bad debt. Therefore, we need to assess a little more from everyone else to cover it. So if that's your case, I think the board, it's within their power and their fiduciary duty to make sure that there are enough revenues to cover expenses. But obviously, the optics of doing an increase right at this moment are not that good. So I would hope that you'd have a very noticeable and important reason to increase them, such as something to do with safety or say aesthetics, or preventing further damage to some kind of HOA asset.
Thanks, Drew. Robert, if we temporarily reduce our reserve contributions or suspend them, do we need to publish a new budget mid-year?
I would say no, it's at least as far as the reserves say. As Drew mentioned, if you're missing a few contributions, that's something that you'll catch up with in the next year's budget in restoring those funds. or higher reserve contributions then, but typically I wouldn't say you need to republish the reserve study mid-year. You want to be working with your reserve study provider, see them as part of the team. By all means, document your conversations, your email trace, any what-if scenarios they run for you. But Drew, do you want to touch on reissuing a new general operating budget, kind of in line with your last question?
Right, I would say no, no need to do that. However, like I said before, you need to leave that on the balance sheet as a due to reserves from operating. So, and leave it there until the end of the fiscal year so that when the auditor prepares their review or audit, it discloses to the membership very clearly that yes, we were not able to fund according to budget when it comes to reserves, and that there is this shortfall there. And then as part of that annual disclosure you do each year, you'll also be able to show the reserve study and how you intend to catch up. And it might be shorter term or it might be longer term. You don't need to notice the membership if you can't fund reserves for a month or two or three or even four. Just make sure it's disclosed in the audit at the end of the year.
And Drew, should we proceed with filing liens, pursuing judgments, or non-judicial foreclosure?
I think you should proceed for sure with the liens, and it'll be up to the board to consider whether to pursue judgments or foreclosure or non-judicial foreclosure. The liens, I think, are important because first of all, they're not that expensive, and they flag that property, that parcel, in case they want to do a refinance or they want to sell. Then the HOA is protected and will get paid. Another thing is that, you know, the county offices have all been closed for months now, and I think they're way behind on a lot of their activities. I have heard that liens are getting recorded because that is something that you can do remotely, and so some of those workers are still getting that done, those county workers in the county recorder's offices. But in terms of getting judgments and doing trustee sales and all of that, the courts are all backed up and closed anyway. So it's almost, it might be okay to get it approved to proceed when the courts are open and available. But as I stated earlier, I don't think you should just do an overall suspension of a certain collection remedy just because of what's going on with COVID. But I do get it where a board might say, oh, look, this person is in trouble. They got behind. They said the best thing to do is at least try and get them on a payment plan. That's usually my advice. If someone has some difficulty, you don't want to throw the hammer down too hard on them. File the lien, but maybe offer them a chance to do a payment plan or work their way out of it. That's my advice. But for the ones that are bigger balances, and in many high rises, the assessments are, they're 4 digits. They can pile up quickly. And so you do need to stay on top of it. You don't want someone lingering for a long amount of time, and that just becomes a burden on all the other owners. So I say proceed to the extent that you can, given what's going on in the county facilities, to allow us to proceed with some of those remedies.
Robert, this question's a little specific, but this I think would apply to a variety of projects. But how would you prioritize a water-saving turf replacement project versus a sprinkler line replacement project where the sprinkler lines are close to end of life?
Good question. Those two kind of go together. It's kind of like painting a hallway and recarpeting a hallway. I don't know the specifics or the need, basically how close to the end of life the sprinklers are, but that would be a project, if at all possible, I'd like to see the association do together rather than do one and not the other. So I'd like to keep that packaged together.
Robert, another one for you. If reserves are borrowed, do we need to pay it back with interest?
Good question. I would say no. It obviously needs to be done. Again, you've been hearing today that all the decisions you make need to be well documented, and that documentation is great, but I've never heard from anyone on the financial side or legal side that any borrowed funds need to be made official by having interest involved. Like if in the same association, if you're borrowing 50 grand from your reserves, that's kind of like right pocket putting into operating left pocket. You don't need to add interest to it because it's your money, whichever pocket it's in.
Thanks, Robert. Drew, what should an HOA do when their operating cash balance exceeds FDIC limits? The property management company has the relationship with the bank, which makes it difficult for the HOA to manage that excess of funds.
That's a great question, particularly for those with very large budgets. You're going to be collecting, say you're collecting $1 million a month of assessments. There are going to be times within the month when you are over the FDIC limit for your operating checking account. And it really doesn't make a lot of sense to try sweeping money back and forth into a CD just for a day at a time or whatever. And most businesses and corporations have to deal with this who have a large amount of money. So that's why it's important to partner for your operating account with a strong, very strong bank. First Services uses US Bank nationally, and they are a very strong and highly rated bank. And we also have a bit of insurance with them, a bond, I believe, that helps protect against any uninsured losses if for some reason there's a catastrophic failure and there's losses above the FDIC limit for your operating checking. When it comes to all your investments, obviously we try to use brokered CDs and or other investment vehicles where you spread out the principal amongst different institutions, so it's all FDIC insured. If you have a large budget and you have operating cash levels of say, over $1 million or even $500,000, we have other options for our clients where we can open money market accounts at other banks in $250,000 tranches to keep those operating funds liquid, but still earning interest and still guaranteed or still covered by FDIC. So if back on that one slide when I was talking about operating cash levels, and that one client had 1.8 or 1.2 or whatever it was, those operating cash balances include operating investments too. So you don't want to pile up extraordinary amounts. When you do have a big balance in operating cash, it is appropriate to move some of it out of checking and keep it in some other liquid vehicle, such as a money market account, where you can earn interest and you spread out that FDIC risk. It requires a little more attention from the manager. They have to be watching it all the time, because if your checking gets low, then they have to move money from the money market back into the checking, the regular checking. But if you have a treasurer or someone who wants to look at it as well, we're very transparent about allowing our clients to see where their funds are parked and real time. And then we set up a policy like where we say, look, if any time the operating checking gets below 50,000, then we're authorized to move it from the operating investment account back into the operating checking account. So I'm getting a little confusing probably for you, but that is a good question, because sometimes people do get their feathers ruffled when they see that there's $800,000 in their operating checking account. And when that usually happens is about the 10th of the month. It's when all the assessments have finally come in. We've done all the ACH pulls and all that money is sitting there. And it's usually just a momentary time, because then we got to start paying the landscape, paying for staff, paying for utilities, et cetera. And so then it moves down quickly. So a long-winded answer is you want to have just the right amount in operating checking so that you don't have lingering funds way over the $250,000 FDIC limit. And if you do, then open some other operating accounts that in other banks that are more like money market accounts, so they're liquid and can be moved quickly and easily back into operating checking. Sorry for the long answer.
That was a good long answer. Thanks, Drew. We're going to take one more question and go ahead and start wrapping up. Robert, this one's for you. Were you saying earlier that reserves are commonly 25% of the operating budget or 25% of the total budget?
25% of the total budget. If you have an association where, let's make the numbers a little smaller than what Drew was talking about, where you're collecting $10,000 a month from the homeowners, then a typical would be $2,500 going to reserves, $7,500 going to operating. It's 25% of the total budget.
But that, of course, depends on your funding level. If you're
yeah, there's so many things.
If you're 40% funded to ideal, maybe it should be a little higher. If you're at 95 or 105% of ideal, then you can maybe lower it, right? So it is all about.
You'll see that in your reserve study. But if I'm picking numbers, well, since I said 25% earlier, it is 25% of total. The numbers that we're talking about, even right here, have to do with percent of total budget, not related to the operating budget.
Thanks, guys. Well, again, I want to thank our presenters today, Drew and Robert, for taking the time out of their busy schedules to share some great best practices and insights with us. As we wrap up, I also want to thank all of our attendees today for taking the time out of your day to attend this webinar. We sincerely appreciate your time and dedication to serving your community. Please feel free to check out our COVID-19 resource libraries at the links above if you're interested in additional resources. And as mentioned, we'll be sending you a recording of the webinar as well as some additional resources. Please let us know if you have any additional questions that we weren't able to get to today, and we'll be happy to help.
Thank you. Be safe. Be well.
Thank you, everyone.